Yesterday, I asked that you did the on your own on page 30, and I wanted you to take a look at the solution to the on your own. Please compare mine to yours. The first line is office equipment, general debit, cash credit. Store equipment, general debit, cash credit for the next one. The property tax expense is $1,800, general debit, cash credit, and the store equipment at the bottom is $325 and $325. Take a look at the postings. Your new balance for office equipment should be $17,280. Your new balance for store equipment should be $10,575, and property tax expense should be $1,800. Today I'm going to introduce to you depreciation. We worked a little bit on depreciation right before I left on my leave. So you're going to need page 31 in the workbook. And this is on page 541 of the textbook. Really no need to turn in the textbook though. I will give you all the information for the top of this depreciation schedule. They're wanting you to do straight line depreciation for a computer monitor. The original cost of this monitor is $560 and the estimated salvage value is $60. Now, I mentioned to you, and we talked about salvage value before, that's the amount at salvage that you can get for the item. The salvage value is not to be calculated in the total depreciation on the depreciation table. So the last line here should always be the salvage value. The estimated useful life of this computer monitor is 5 years, which is pretty realistic, and the bought date would be January 3rd, and you can put 2016 or 2017. Okay, so here our category titles are beginning book value, annual depreciation, accumulated depreciation, and ending book value. So for this should be 2001 up here. For 2001, the beginning book value, of course, is $560. Now, how do we figure the annual depreciation? Straight line depreciation is exactly that. Straight away, you are going to depreciate this asset the same amount every year of its useful life. In order to calculate that straight line depreciation, and I gave you one of these examples again before I left on leave, you're going to take the original cost in your calculator, $560. You're going to subtract $60, which is the salvage value, which is non-depreciable, and then you're going to divide the remainder, which is $500, by the 5 years of useful life. I'm going to repeat that. Take your original cost, subtract your salvage value, which you're going to get $500, and divide 500 by the 5 years of useful life. $100 is how much you're going to depreciate this asset for every year of its useful life. So, by starting with $560 book value and subtracting the annual depreciation for that first year, the accumulated depreciation so far is $100, and the ending book value is 100 minus 560 equals 460. Bring this 460 down to the next line. 460 is your beginning book value for 2002. Annual depreciation is straight line, so every year it's going to be straight lined for $100. Accumulated depreciation now is this 100 plus this 100, which is 200. Your ending book value that year is going to be the 460 minus the 100, which is 360. Bring this 360 down to the next line. Because your beginning book value for 2003 is $360. Once again, annual depreciation is straight line. Subtract that from that, Your accumulated depreciation is the first year, the second year, the third year, which is $300. And 260 is your ending book value, which is 360 minus the annual depreciation, which makes 260. Bring this $260 down to your beginning book value for 2004. And again, you have a $100 annual depreciation. Subtract your $100 depreciation from your 260 and you're going to get 160 with annual depreciation or accumulated depreciation, for $400. The 160 is brought down to the beginning of the last year, 2005. Subtract the 100 from the 160 to get $60. And your accumulated depreciation is going to be $500. So this is straight line depreciation. A couple things I want to remind you of. Straight line depreciation means the same value is going to be depreciated every year of that asset's useful life. The ending value here never can exceed the value of the estimated salvage value. You want it to be exactly how much the estimated salvage value is. Now, straight line depreciation is great for a computer monitor, for a Xerox machine, for a file cabinet. It is not good for an asset that is such as maybe a vehicle, where it depreciates 20% when you drive it off of the lot. That's a different type of depreciation that we'll talk about later. That's the work together. There's a work together on the bottom here as well. That is a notebook computer. It's a straight line depreciation as well. The original cost of that notebook computer is $2,750. The estimated salvage value is $350, and you have 4 years of its useful life. October 19th, 2001, you are going to be depreciating this asset for. Now, the big difference between this problem and the one up above is that we are not starting at the beginning of the year, such as January, for the asset up above. Notice this is January 3rd, the beginning of the year. Here we have October 19th, 2001. That will complicate things just a little bit. I want you to notice that in 2001, it's showing here that the annual depreciation was only $100. I'm going to show you how to calculate that. On your calculators, take this $2,750, $2,750. Subtract the salvage value, which is $350. $2,400 is how much you're going to depreciate. Once again, you never depreciate the value of the salvage value. $2,400 divided by the 4 years that you are going to be depreciating is $600 a year for a full 12-month year. Well, this first year, you purchased it in October. You purchased it past mid-October. Therefore, you are not going to depreciate the month of October at all. You're only going to start depreciating for November and December. That being said, you're going to take 600, divide it by 12. For 12 months out of a year, $50 every month is how much you're going to depreciate. Well, the first year you cannot depreciate for 12 months because you only are depreciating for November and December. Therefore, you're going to take 50 times 2, 1 for November and 1 for December, which is your $100 annual depreciation for that first year. So you're going to put $2,750 here and $100 here. Subtract the $100 from the $2,750 to get the $2,650. Bring the $2,650 down here. Now before I told you, remember, $600 is how much you're going to be depreciating annually. How did I get that $600 again? I took $2,750 minus the salvage value, which is $350, equals $2,400 divided by 4 years of useful life equals $600. So this is a full year, this is a full year, and this is going to be a full year. You're going to take the annual depreciation, subtract your book value to get this number here. This accumulated depreciation is just this plus this equals this, and then this plus this equals that, and then all of these equal that, and so forth. You're then going to bring $2,050 down to the beginning of 2003. Subtract the whole $600 to get $1,450. Bring $1,450 down, subtract the whole $600 to get $850. Bring $850 down. Now, why do we have $500 here? We cannot exceed $350 here. Therefore, if you take $850 minus the $350, you get $500. So therefore, you are only able to depreciate $500 of this $850 because you cannot go past the $350 because that's your estimated salvage value at the top. Now, when you purchase an asset in the middle of the year or at some period in the year, that does complicate things a bit. So if you need to watch this video again before you tackle the on your own, please ask Miss Anderson if she will show it to you again. At this time, I would like you to do page 32, the on your own. Now you are going to need to refer to page 541 in your textbook to get the information at the top here for those problems.